Welcome back, focused learners. Today, we're putting on our quant analyst hats for a brand new explainer. We're looking at a truly fascinating and honestly pretty surprising phenomenon in decentralized finance right now. It's called market decoupling. We're going to take a measured, highly objective look at how PLAZM is actually demonstrating price independence, just completely breaking away from that standard correlation we're so used to seeing with broader market sentiment. To figure out how real yield creates these countercyclical assets, here is our roadmap for today. We'll start with a decoupling anomaly, break down the real yield engine, look at protocol health and safety, dive into multi-cycle compounding, honestly assess system vulnerabilities, and wrap up with the repricing verdict.
All right, Section 1, the decoupling anomaly, or when mechanics defy sentiment. You know the fundamental problem in crypto, right? Price discovery usually relies almost entirely on market hype.
Okay, let's dive into this because the divergence here is striking. Normally, when the fear and greed index rises, like we saw with a 10-point jump from 31 to 41, correlated assets either drop or stagnate as panic sets in. I mean, Ethereum was sitting completely flat at a negative 0.06%. But in that exact same window, PLAZM climbed a positive 4.45%. It's wild to watch the broader market react emotionally while a protocol just quietly does the math, executing its programming right against the tide. So what's actually powering that mechanical movement? It's real capital. The total claimed profits sit at an incredibly impressive $1,806,589.82. And what's absolutely crucial for our analysis today is that this number jumped by exactly 0.7K in just a single 24-hour period. This proves that this anomaly isn't just retail luck. It's backed by protocol-originated value. Moving on to Section 2. The real yield engine. Let's tune out the market hype for a minute and look at the cold hard math behind this independence. Let's break down the daily metrics. The central vault currently holds a very healthy 242.0983 ETH. That collateral is generating exactly $92 a day in yield. And what does that do? Well, it allows the protocol to mint 3.2 bonds daily at a 31.2% APR. The biggest takeaway here is that this daily yield is entirely self-funded. It explicitly does not require new external inflows or new retail buyers to keep functioning. And that leads us straight into compounding mechanics. Basically, the protocol systematically reinvests its own generated yield. Specifically, 20% of it goes straight into a buy and grow function. This continuous internal reinvestment guarantees steady protocol-specific asset accumulation. The yield is literally buying its own bonds from the market, which holds the bond price firmly at $24.55. It's a beautifully closed-loop engine driving its own demand. Which brings us to Section 3, Protocol Health and Safety. Verifying the foundation. Because look, any quant analyst will tell you that a yield engine is only as good as the security it's built on. Now, what's really interesting here is the Aave safety levels. We're looking at collateral of 323 ETH and 250,000 USDC. But the absolute most important metric is the health factor, which is sitting at 2.05 plus. In DeFi terms, a score comfortably over 2 means the collateral more than doubles the debt. That creates a highly robust foundation. It minimizes any immediate threat of liquidation, keeping the whole engine running safely. On top of that, the buy and build, or BBB status, shows reserves at $3,110. Now, you might think, well, that's a smaller nominal number, but the real power lies in the steady daily additions. Because it's fully automated, it acts as a mechanically countercyclical force. It just keeps buying during periods of high market fear, exactly when emotional traders are selling off. Let's jump to Section 4, multi-cycle compounding. We've seen the daily metrics, but as analysts, we need to project this over a multi-cycle horizon to see how these mechanics really play out. Let's walk through how this builds. Step 1. A single 77-day cycle at current rates yields roughly $30,200. Step 2. 20% of that is reinvested, meaning about $6,000 buys approximately 245 new bonds. And Step 3 is where the math gets beautifully aggressive. As this pattern repeats into cycles 2 and 3, those 245 new bonds start generating their own yield. The compounding accelerates exponentially, projecting claimed profits cleanly past that $2 million mark. Section 5, System Vulnerabilities, Assessing the Risks Objectively. We have to remain grounded here and deliberately examine the architectural weak points of these mechanics. Because let's be real, no system in crypto is entirely risk-free. This entire decoupling model relies heavily on vault sustainability.
A severe vault crash could, theoretically, drain the system's capital. Plus, even though we just established that the Aave health factor is a very safe 2.05, a black swan event causing an Aave liquidation would fundamentally break these compounding mechanics. The protocol is far from danger right now, for sure, but these are the vulnerabilities we have to continuously monitor.
Finally, Section 6, the repricing verdict. Let's bring this case study to its logical conclusion and talk broader market implications. And this brilliantly illustrates the trajectory we're on. In the past, these assets were strictly tied to retail sentiment. Today, that positive 4.45% divergence we saw, that's merely the opening move. It's the first clear signal of protocol-specific pricing. Looking ahead, as those multi-cycle compounding mechanics accelerate, a completely new price floor is established entirely independent of market mood. From a quantitative perspective, this means a repricing isn't just likely, it's mathematically inevitable. To wrap up our explainer today, the core thesis boils down to this. Independent real yield is exceptionally rare, and this is a protocol explicitly built to thrive in a bear market. Real yield simply doesn't need new capital to keep pushing the baseline forward. So I want to leave you with this to ponder. If a protocol's engine can mechanically grow its own treasury, mint its own bonds, and raise its own price floor entirely without relying on a single dollar of new external capital, how long until the rest of the market catches up and finally prices it in? Thanks for joining me on this deep dive into the mechanics of price independence. Stay focused and keep learning.